Well, welcome everyone to this webinar. And firstly, thanks for taking the time on a Wednesday morning. We know how busy you all are as business owners and operators, and you know, it's great that you've taken the time to jump on this webinar. So what we're going to be talking about today is, you know, a lot of you will have been following the kind of LegalVision webinars we've done throughout the COVID-19 period. What we're focused on today is really kind of more medium term. How do I manage my cash flow in a more kind of medium term environment? So what are we talking about? Ultimately, the COVID-19 shock that happened in you know, March, April, May has sort of subsided, and we're now in a situation where you know, this is the new kind of economy. This is how things are going to be for a long period of time. So what we've got is Jace Gawne-Buckland and Hugh Perks from Grant Thornton, an accounting firm, who are going to be giving us some insight into, you know, really what you need to be thinking about in the short, medium term around kind of cash flow issues. So before we get into it, I won't introduce myself because hopefully most of you know me, LegalVision CEO. Been doing a lot of these calls, so most of you will have been on one of these before. I'm going to let Jace and Hugh introduce themselves and tell us a bit about what they do and what Grant Thornton does with businesses, and then we'll jump into the webinar.
Great, thanks, Lachlan. I'll start us off. My name's Jace Gawne-Buckland. I'm a partner at Grant Thornton. I'm based in Melbourne, and I'm in the private advisory team. I might explain quickly what private advisory does, and then maybe I'll pass to Hugh to introduce himself, and Hugh can talk maybe a little bit more about Grant Thornton. So I've been with the firm for about 13 years now, always been in Melbourne, but the beauty of being in private advisory is that I've done quite a lot of secondments out to our clients and being part of their finance team, so I can see what it's like from that side as opposed to just being the professional services side. In private advisory, what we do is we basically work with small to mid-sized privately owned businesses, and most of the time those are growing businesses. And we also get to look after the owners behind those businesses, so the high net wealth individuals or the families behind those businesses. And we help out with a range of different services. A lot of that for the business will be around accounting, tax, and advisory, being things like performance reporting, forecasting, and Hugh and I do a lot of CFO type services as well. Me in particular, I work a lot with tech-based businesses and also professional service businesses as well. And for the family office, for the families behind those businesses, the owners, we do a lot of family office services as well. So hopefully that gives you a bit of a flavour of what we do in private advisory. You know, in addition to that, you know, the accounting and tax and structuring type work, we also assist those businesses with performance and growth and strategy. So we're often part of those conversations when the businesses are looking forward and planning, both from just a general business perspective, but also from a cash flow perspective as well. So I hope that gives you a bit of insight into private advisory. Hugh, might pass to you now.
Thanks, Jace. Hi, everyone. My name's Hugh Perks. I'm a director in private advisory in the Sydney team. So similar to Jace, I'm working on a range of different clients in the private space, so small to medium-sized businesses, and really getting involved in what they do. I grew up in Adelaide. I started my career there and moved to Sydney about 8 years ago. I do a lot of outsourced CFO work, general tax advisory work, and work on a range of different clients and industries. In providing these CFO type services, there's a strong emphasis on running a smooth finance function and also having strong cash management, which is what we're here to talk about today. Just a bit about Grant Thornton. So we're a full service firm here at Grant Thornton with many specialists across tax, audit, financial advisory and consulting. So we have 6 offices in Australia with about 1,300 people nationally. We're a global firm across 140 countries. So we can easily assist with inbound and outbound expansion. So our reach is pretty wide. We help a range of different businesses across many different service lines. So there you go. That's a bit about us and Grant Thornton.
Cool. Thanks, guys. All right, let's jump straight into it. So again, just to reiterate, what we're focusing on is cash flow and how you can manage your cash flow in a way which is going to help you, not just in the kind of immediate COVID-19 right now period, but in the next kind of 6 to 12 months, where I think everyone agrees economically it's going to be a difficult time. And so business owners, operators are really going to need to be thinking about this, pretty much every day. So the first question that I wanted to kind of ask you guys is, obviously, hopefully everyone's been dealing with, kind of thinking about cash flow up until now since the whole COVID period started. But if you've got immediate cash flow issues right now, what are some things that you can do, to kind of help the situation, right now in a more kind of immediate sense?
Well, maybe Hugh, I'll take this one. I suppose that the first thing really is to diagnose what is causing those cash flow problems, as this is going to direct your attention essentially. Now, when you say immediate, I'm hoping that people dialing into this call don't have super immediate as in today issues. I think if you're in that situation, you probably need to call in a recovering and restructuring expert who can come in immediately and maybe help you to make some difficult yet necessary decisions to move the business forward. But let's assume that we have a little bit more time than that, and really you're identifying some cash flow concerns that are going to be affecting your business in the short to medium term. I think that once you've got a handle on where those cash flow concerns are coming from, then you've got a better ability to be able to attack those areas and really just make sure you've got the right strategies in place to maybe stem the problem essentially. So there's a few different areas that you can look at in your business. There's a few different strategies that you can put in place. Maybe I'll just talk quickly first about just having some cash flow controls in place and some good governance. So you should probably look immediately to increase your restrictions or remove your authorizations relating to bank accounts and credit cards or other spending mechanisms across the business. And that also includes things like maybe reducing the spending limits for your supplier accounts and things like that. So you're just wanting to try and put a bit more of a stop on the amount of cash that's going out of the business and have a bit more control over that. One thing that you want to do pretty quickly throughout this period is assess your different funding options. And so that would include things like your bank or your financial institutions, and going to them and just making sure that you're fully aware of the facilities that are available to you, the facilities that you currently have, and anything that you might be able to call upon if the situation arose. You can also have a look at quick short-term loans as well. Those fintech or online providers that'll give you just a quick immediate cash boost. And you can also have a look at your tax debts as well. So your tax debts throughout this period, the ATO have been pretty accommodating in terms of going to them and working out payment arrangements or plans that you can put in place to help you manage those tax liabilities through this time. Obviously, one main strategy is going to be to limit your costs, to try and reduce your costs. And that's really just a process of going line by line through all of the costs to your business and working out where you can gain any efficiencies. This includes, going through, say, your rent and making sure that you've had the right conversations with your landlords and worked out whether you can reduce your rent at all there. Looking at utilities and working out whether you can aggregate those utilities. Looking at discretionary spending items throughout the business, like subscriptions, like staff entertainment or amenities that you can potentially reduce a bit and just save a bit of costs there. And obviously looking at your staff and from an internal restructuring perspective as well, also considering that are the right people in the right roles and are they focused on the right things.
Jace, are you seeing, when you've got clients coming to you with these sort of cash flow issues, are you seeing a lot that can be done? Like, is there a lot generally in the kind of average business that can be done from a kind of cost perspective, that maybe pre-COVID, the owner, the operator was kind of not so focused on that and there's actually lots of opportunity there, or are you kind of seeing businesses already pretty lean, so it's hard to kind of do much from a cash flow perspective from that side of things?
I think that if we're talking about right now, yes, I think that the owners and leaders of businesses have had a look at those different areas and already reduced some of those costs and put in some of those strategies, because we've essentially now had 6 months of COVID. At the start of COVID, so in that March period, there was a bit of, I don't want to say panic, but business owners and leaders were more concerned then because they may not have been focused on cost cutting measures in their business. And so the conversations that we were having with clients prior to March were a lot more about growth and the future of the business and planning out that next 12 to 18 months. And the business they were sort of operating efficiently, but the focus wasn't on cost cutting. Then COVID hit and March came about, and the business owners went, well, hang on, we shouldn't be focusing now on that 12 to 18 month outlook. We should be focusing a little bit more now on just making sure that our business is resilient. And part of those, the resilient strategies is looking at making sure that your costs are down. And so now the businesses are probably running a lot leaner than what they were in March, but there are still absolutely things that you can do, and that we have these conversations with our clients every day where there's a lot that business owners and leaders have to focus on. And so they may not have gotten around, they may have had a look at their creditors and the amount of cash that's going out the door, but they haven't necessarily looked at ways to collect from their customers, and get money in sooner there. So there's definitely areas that we're still talking about, but business owners and leaders have trimmed a lot back in their businesses and become a lot more efficient over the last 6 months.
Yeah, and Hugh, in terms of, I think that's a super important one. One, if you're running a professional services firm, certainly is that your debtors, there's usually, like a good chunk of cash there that ultimately, you might not have been really focused on collecting as much as you could have been. Are you seeing business owners really make a kind of a dent in their cash flow issues by focusing on kind of debt collection? And if so, what are the strategies outside of the kind of normal kind of way of collecting your debts that you're seeing people use?
Yeah, sure. I mean, there's a lot to go through there because it's all working capital, and that's kind of a big part of answering this question. So look, it's not just an accounting team or finance team focus. It should be the focus of the whole business, and good working capital requires significant discipline within the business. So even small improvements in key metrics can have huge cash flow effects. So we might just start here by going through the different areas of working capital management. So you mentioned debtors and so on. So we'll touch on debtors, inventory management, and creditor management. So we'll start there and run through some of those key areas. In terms of inventory management, there's a range of different things you can do, and I'll run through some of these now. You can utilize where possible to reduce manual errors and improve order accuracy. Consider implementing customer portals to manage this. You can also implement really good internal controls around inventory counts, transfers and procurement, and this will ensure efficiency in replenishing and maintaining inventory. We can also consolidate vendors. This can have great benefits, including price concessions and extended payment and delivery terms. We'd also look to get you to organise suppliers to deliver goods directly to customers where possible, when this can reduce shipping and warehousing costs. Things like considering centralising inventory management through regional or national hubs and reducing warehousing and streamlining delivery is a good thing to do. And reporting to stakeholders should be in real time, because you can view quantities on hand, costing of goods and location of goods. And these KPIs should include inventory levels such as order fill rates, inventory turnover and capacity utilization. There's a lot of things there to focus on in terms of inventory. And if you look and step through some of these particular areas, you're going to be able to really find some cash flow savings amongst these, but it is a bit of a process that you have to run through. You don't just look at one little bit, you've got to look at it all together and run through the different steps and really just try and get incremental cash flow savings there.
Yeah, and I guess this is really dependent on the type of business that you're running. I mean, if you're a business that's obviously, an inventory-heavy business, then that's where you can presumably, generate a lot of kind of, cash flow benefits. But if you're a professional services business, then, really you're probably more looking at your WIP and billing your WIP as efficiently as possible. I mean, what are the kind of for those different types of businesses, do you normally recommend, hey, there's like one main thing you should focus on, or do you actually go, you know what, there's really 4 or 5 things that you should focus on?
Yeah, there's a range of different things there on the debtor side, and maybe Jace, you want to run through those ones because we've got a good number of things to touch on there.
So Lachlan, I suppose there, when you're talking about businesses that may not have inventory, and so you're talking about a professional services business where you do have your WIP, there you still can apply some of those inventory style principles, but just to your WIP instead. And so your key sort of KPI or metric there is your lockup days. And so when the work is actually being done to when it's being billed to when you're actually collecting the cash there. And so it's about making sure you have the right principles, the right processes in place throughout that to make sure that that process is as short as possible, because when you do the work, you want the cash in the door from it. Once you've actually billed, then you've obviously got a whole range of things that you can do in terms of your debtors to make sure that you're trying to get that cash in quickly. First of all, you probably want to have a really good credit approval process with clear policies in place for approving customers and issuing credit and recovering debt. You want to have this like a process in place to regularly review your customers and ensure their stability as well. And there's particular concern at the moment around voidable transactions and making sure that they don't occur in this climate because we are in a recession. So they might happen. So making sure you review your debtors to make sure that they're in a stable condition as well. The details around those debtors, so your customer sort of master data, and we've done a bit of work on this with our clients, is that making sure that their master data is up to date and correct. If you get something wrong there, it causes manual hours, it's time and it's cost to the business. And so making sure that your customer data has things like contact details, addresses, credit limits, payment terms, discount and return policies. All that sort of stuff needs to be in your system, so it's just as efficient as possible. Have a billing process, and this is what I was talking about before, just have a billing process that ensures accurate invoices are sent on a timely basis. The sooner you get those invoices out, the sooner, hopefully, you're going to get payment. And I've also seen a few customers use some softwares to put customer portals in place as well. And so the customer can essentially log into the portal, see what's outstanding and make payments through that portal. And that just reduces man hours and makes the whole process a bit more efficient.
It's an interesting one because at LegalVision, we're obviously a professional services business. We service lots and lots of clients. And so what we did about a year ago is we launched a membership program, right? And that membership program it has a bunch of products. The main one being you can call up at any time, speak to a lawyer, all for a fixed monthly fee of $200. But on top of that, you get access to discounted fixed fee prices compared to our standard prices. But a key benefit for our business of that, obviously great for clients, but you have to access the membership, you have to sign up on Stripe, provide your credit card details or bank details. And what that means is every month we just pull whatever the fees are for the month from the client's bank account or credit card, which obviously means we don't have to have that whole back and forth with following up on invoices and invoices being paid late and so on and so forth. So that sort of approach, building a kind of membership type approach, or at least an approach where you're getting clients to sign up on Stripe or an equivalent type of payment gateway and give you permission to just kind of pull the cash for the invoice on a monthly basis. That makes a big difference, I think. If it works for the business that you're in.
Yeah, spot on. And that's all just coming back to that, reducing the amount of admin and manual hours that are going into certain tasks within the business. Because as Hugh said before, even the most minor improvements in certain KPIs across the business will result in profit and cash at the end of the day. And so, even further to that, things like when those payments are coming in, and if it's not that sort of direct debit process, if it's a different process where you're getting paid into your bank account from those customers, making sure that the payments are allocated to the right invoices, it's just going to reduce that sort of reconciliation time required later on. And any of those reports that are coming through from those collections, making sure that those reports are timely and have the right information in them. And again, offering things like incentives to make early payment are always really good, just to get cash in the door. So whether you need to discount a certain fee or whatever to get that cash in, then have a think about doing that. Another one there is writing off bad debts as well. We tend to see business owners and leaders focus a little bit too much on those bad debts, and it's frustrating when you do have a bad debt. But if the amount is relatively minor, just write it off and take the tax deduction and collect your GST and move on and focus on more important parts of the business. And the other one there is just to make sure, from a customer and a debt perspective, consider factoring and financing. That's another one of those finance options that are available. So talk to your bank or talk to a specific provider around that type of finance, and that's really going to help smooth your cash flows out as well.
Okay.
What about we talk about the other side of that as well, the creditors? Who do you want to take through creditors?
I'm just going to quickly just tack on and just add an additional point to what Lachie was mentioning around professional services firms and how you've set up the memberships and direct debits. Is where we see a lot of businesses pivoting onto like a subscription type model, and that's really important with that recurring revenue nature of the business, which means that the cash flow just keeps coming in when you expect it to come in, which is similar to what you were saying. Businesses that have lumpy cash flow because they're sending out big invoices irregularly and they're not sure when they're going to get paid will struggle to manage their cash flow more. So we do see businesses wanting to get that recurring revenue nature, and then that also helps like on a range of different things, but valuation is important too, because that recurring revenue nature of the business also helps increase the value of the business. So not only is it good for cash flow, it actually improves the value side as well. So I just wanted to mention that.
And from a resourcing perspective, it becomes much easier to resource, because if you know that you're selling X number of memberships a month and you know what your churn rate is and all those numbers, you can go, you know what, in 4 months' time, I'm going to need 2 extra lawyers to service the customer base, and you can hire with much more certainty. And I think you can look at that across different industries, and it's something that that just makes running a business a whole lot easier. Having said that, I do think a lot of professional services businesses are probably not suited to a membership subscription kind of model, because their core capability is doing big transactions, for instance. If what you do is big transactions, it makes no sense for a customer to sign up to a subscription. So, I guess you've kind of got to go, is what I do suitable for a membership subscription model? And if so, you can consider it. But yeah, it's not suitable for everyone. Hey, we were talking about creditors. I think it'd be good to kind of get some view on, okay, beyond beyond you've got your debtors. What else can you do from a kind of creditor perspective to really kind of manage the cash flow? Not necessarily in professional services, but in other industries. What are you kind of seeing people do?
Yeah, so I mean, it is a big part of the business. Again, falls into that working capital side of things. So if you can get creditors right and have good processes around how you manage it, then you're going to see those cash flow improvements build up and help the business. So a couple of tips we'll run through on this side here. Would recommend developing a vendor selection process that includes negotiation of favourable buying terms. And tips for some of those negotiations would include performance scorecards and leveraging these scorecards during negotiations. So you want to favour your really good suppliers and treat them well and know how you're going to deal with these guys. You also want to demonstrate reliable payment history or buying power and negotiate better and longer payment terms in regards to this. You should regularly seek opportunities to negotiate better pricing as well by comparing the market. So really know who which suppliers you can be dealing with, and leverage volume discounts as well.
Mm-hmm.
I think looking to avoid purchases and payment errors by ensuring that your master supply data is complete and that you've got all your pre-approved vendors with spending limits in there. So you kind of know that your supply file is really robust. It's all in there, it's been checked, everything's up to date, and you can review this regularly to make sure that there isn't any slippage or errors in regards to this area. You also look to complete vendor contract reviews. So comparing the terms against industry standards, ensuring vendors are continuing to meet their terms. And if they're not, then you might have negotiation leverage there. You also would look to ensure you're constantly exploring any early payment discounts, similar to the debtors where you're trying to offer discounts to bring in the cash. It's similar to the other side. You can explore early payments to reduce the amount that you're paying. Although it's kind of, you reduce the overall cash spend. In this, you might have to then, balance that out between actually paying a bit early. So it's kind of up to you to manage that cash flow and understand if you can afford to send that payment out earlier to get that discount. Also ensure real-time payable reporting to stakeholders with key metrics such as accounts payable days. So use those metrics to track how you're going with your creditor management, and then refine that on an ongoing basis if those creditor days or accounts payable days start slipping out. Just really look back at these tips or processes to try and rein that back in. So that reporting side is quite critical.
Okay, good. All right, hey, conscious of time, what we want to do is leave a whole bunch of time for attendees to ask questions. So let's jump into some audience Q&A now. Now, if you've got questions, everyone in the audience, just type them in to the question box, and we'll kind of get to them, if we can. First one, which is an interesting one, I think, and obviously borrowing is what a lot of people are trying to do right now, at a time when I guess the banks are under pressure, maybe less likely to lend. So a good question we've got here is, how do you get banks or second tier lending firms, I guess the fintech that Jace, you mentioned before, to lend to privately owned growth businesses on an unsecured basis? So how do you go about that? Is it even possible right now?
Okay, I'm going to have a crack at answering this, but I would ask everyone to remember that I'm not a banker, and so take everything that I say with an ocean of salt, and maybe talk to your broker or your banker in relation to this. But I would say that obviously unsecured loans are a little difficult. In the current lending market, what I've seen is that there's a real focus on conservatism and quality. And so that usually requires security most of the time. However, I will say that if you are a strong bank customer or a potential bank customer, and then you probably have a greater chance of being able to secure an unsecured loan. What I mean by that, when I say strong bank customer, you can demonstrate to your lender, so whether it's bank or second tier lender, you can demonstrate to them that you have the ability to repay or cover the debt, and possibly repay it in a shorter amount of time to what it would usually. So usually commercial loans are in that sort of 4 to 5 year range. If you can prove that you could repay it in 3 years, then the bank's going to be a little bit more open to lending to you. And you can also prove that you satisfy certain key covenant ratios, like we often see interest coverage and liquidity ratios. And so if you can prove that you cover those, then they're going to be more willing to lend to you. But that sometimes falls in that whole, what's the saying? The banks will only loan to those who don't really need a loan. And
right.
So, I mean, let's just talk quickly about some of the things that I've seen from maybe a small, medium, and larger loans. So small loans, banks and second tier lenders, and even those online fintech providers that I mentioned before, they usually cater for loans that are in that, or funding that's in that sort of 50 to 250K range, let's say. And usually what's required there to show that you can that you can repay that debt and service it along the way is that it's different for banks and those online providers, but usually you have to show something like you have a profit or you have positive cash flow. So usually you have to provide bank statements, or that you have a certain period of trading even. That's sometimes a criteria point. So that's usually the case for those small loans. Now, if you want to get a loan that's larger than that, and again, we're talking about unsecured here, it's a little bit difficult, and I don't fully understand, or I understand this, but I don't fully know the details around this. But last year, there was a bit of a change either from a law or ruling or a regulatory standpoint, where the recourse available to lenders for loans that were under 3 mil was reduced. And so if you have a lend that's under 3 mil and you default on your key covenant ratios, then there may not be as much recourse for a lender. And so that's forced these banks and second tier lenders to really go after security when they're lending in that range. When you're talking about a larger lend, so that's in that sort of above 3 mil, most of the time that's for a business that has, multiple shareholders, or that, they have a good finance team and financial management. Sometimes they even prepare audited accounts. Usually this provides a level of confidence to the banks. And so, and that's a confidence around repayment of the debt, but also satisfying those key covenant ratios, that the financial covenants that are built into those lend agreements. So you're often able to get a bit more of that sort of unsecured. And when I say unsecured, most of the time it's secured sort of against cash flow of the business, the goodwill of that business. And it also can depend on your industry as well. So we've spoken about professional service businesses, and I know that I think it's ANZ have a professional they have a certain range of products, or a certain product for professional service firms. And usually that's, they can extend out the repayment terms from the normal 3 to 4 years to, I think it's a longer period, it's like 10 years or something like that. So it's also possibly industry specific as well. Oh, and if your particular lend that you're going for is part of a bigger bank or bigger lend profile across the bank or the financial institution, then you probably have a little bit more sort of power there to negotiate an unsecured loan. So there's a few things there, but still, banks are very much about security or director guarantees. So.
Yeah, and I think that's a good point there, that you need to think about when we talk about unsecured. I think people get a bit confused around what are we talking about in terms of security. No one's going to lend your business money and not have a GSA or general security agreement, so take security over the assets of the company. I mean, that's in the space that we're talking about here, that's pretty much unheard of. So you've got to accept that you're going to have to give security over the assets of the company. The question then is, are you going to have to provide a mortgage on your family home? That's one thing. And then the other thing you've got to kind of be looking at is, do you have to provide a personal guarantee? So when we look at our clients in this space, and particularly the kind of more the growth tech startup space, there are lenders now who will lend to growth-oriented tech businesses and lend only with a GSA, with no personal guarantee and with no mortgage over a family home. And that kind of debt, at least in the startup space, is called venture debt. Now you pay, a higher interest rate on that sort of debt. You're looking at kind of 11, 12% sort of interest rate, and you're also going to be issuing a warrant to the lender, which enables them to buy some shares in the company on a future exit event. But that type of venture debt is becoming more common in Australia. There's 3 funds I can think of. One Ventures have a fund, Partners for Growth have a fund, there's Leap Capital, and they're really looking for the types of businesses that I guess a VC or venture capitalist would be interested in investing in. And the whole idea there is by taking on venture debt, you're taking less dilution than you would if you were raising venture capital. So the capital exists, but you need to be the right type of business, and the type of business that's frankly growing very quickly, and that again the lender's got a belief in the team, a belief in the fact that there's a there's a bit of financial savvy in the team, and so on and so forth. But yeah.
And usually those lends are between that 3 to 5 year period as well. And usually they're in that sort of 3 to 10 mil range. So it's a little bit more than what you would usually go to your bank or your second tier lender, or maybe second tier lender, but usually they're in that sort of larger range. And as you say, usually it's a bit of a hybrid as well. There is some sort of equity component to it.
Well, this is exactly right. So often a deal will be done where there's, say, 3 mil of equity, 3 mil of debt. And so again, the lender's got some comfort that because they sit above the equity in the waterfall, they're more likely to get their money back, I guess. So
yeah, exactly. And that's what we also expect as well, is that given COVID and given the way that the economy is right now, what we think we're going to see over the next sort of few years is at least initially a period of recapitalization and tight liquidity. And where we talk about the bank debt, banks at the moment are a little bit reluctant to take on new customers. And so there is that real sort of tight liquidity phase. And those sort of venture debt and non-bank lenders sort of options that we're talking about, even though they are higher interest rates and things like that, and maybe even have that equity component, that hybrid, they probably will be looking to take advantage of that sort of that constricted model from the banks of taking on new customers. They're probably going to want to increase some market share and the like at the moment, just during this phase where you may not be able to go to a bank, and this may be your option.
Yeah. For anyone who's listening, interested in venture debt, you can check out on our website in the publication section. We have a publication which is a venture debt manual. It explains everything about venture debt, has some case studies and so on and so forth. So check it out if you're interested. Got another question here. This is a good one from Belinda. Do you recommend discounts for prompt payment or implementing different cash collection methods? At the moment, we only offer direct debit. We're a small business and deal with multinationals with atrocious payment terms, 60 to 90 days. So I guess there's a couple of points in there, but what's your view on discounting for prompt payment, and how do you kind of work out the amount that you should discount, I guess?
I suppose it fits into your overall costing of your service or your products, and how that discount will affect your bottom line at the end of the day. A lot of the time, businesses are affected by the customer that they have. And I know that if you're dealing with some of the bigger ones, like, if you're in manufacturing and you're dealing maybe with a Bunnings or something, let's say, they sort of dictate the payment terms there more than what you can. So you can offer a discount up front. And I suppose that calculating that amount, again, just comes back to how much of a hit you want to take on making sure that you get that cash in. But depending on who you're dealing with, you may be at a little bit of their mercy in terms of that payment period.
I guess the benefit of having a customer like a large multinational is you will get paid. So one thing, and Hugh, you might have a view on this. One thing we sometimes recommend with clients who are in a not a dispute, but almost a dispute with clients as to whether they should be paid is to offer a discount on the bill. Not so much, more to like make sure you get paid at all, not necessarily just to get paid right now, if that makes sense.
Yeah, it's interesting. I mean, as Jace kind of mentioned as well, it's a fine line between giving away too much to get the payment in, and and that affecting your bottom line. So yeah, I think it is a challenge. You've got to really understand and have those good relationships with your customers, and just understand why they're paying slow. Because a lot of the time it might not be the person you're engaging with, but it can be their finance team that's kind of holding things up because they're trying to manage their cash flow. So it's just trying to understand the relationships you've got in there, who you're dealing with, and try and pull the strings within the organization to try and make that happen. Because that might be, an avenue you can take rather than trying to offer the discount. Really just try and work those relationships to make those payments happen. Because the way these bigger organizations can work is they can have a monthly payment cycle, and if they miss that cycle, they go, oh, sorry, we missed the cycle, we're going to put you into next month, and that month can be critical in terms of your cash flow. So you just got to make sure that they're getting in and putting those payments in.
I mean, to specifically answer Belinda's question, I think if I was kind of, you know, running a business where my clients are all big multinationals, and you know, so frankly, you would think you could go to a factoring business and say, hey, we've got these big multinationals as clients. We are going to get paid. There's no issue around that. It would seem to me factoring would be a good option there, right? Because you know, then you're getting your cash straight away. You're taking the factoring discount, but you know, you don't have to, because the reality is it's very difficult to go to them and say, hey, I'll give you 15% off. So you pay me now. Like, they're kind of like, yeah, you got someone in the procurement department who couldn't care less, frankly, about, you know, your 15% discount. But a factoring business, you know, this is their job, and your customers are much more likely to pay than the kind of average small business. So that potentially would be an answer for Belinda.
Yeah, I think that's more a more appropriate option there as well. And I think that the quality of your customer means that you're more likely to get factoring in place. So if they are big multinationals that are quality and you are going to get paid at some stage, then factoring is probably a pretty good option there.
We see a lot.
We've only got a couple of minutes left. I'm super keen to get your insight into how you go about dealing with the ATO. So Jace, you mentioned a while back that you know, having a conversation around delaying paying your kind of tax bill is a key kind of thing that you can do right now to manage cash flow. Hugh or Jace, how do you actually go about that practically? I mean, that's something that might be quite difficult for a lot of people.
Yeah, look, the ATO is being very accommodating, as we've discussed before briefly, but in regards to assisting a businesses with their tax liabilities, they've already said that they're going to come to the party and just have those chats with the businesses, and they've put in various things like deferrals of IASs and BASs, and look, favourable terms in terms of interest and payment arrangements being put in place. So we've been chatting to the ATO a lot. Like, it's something we're doing on a regular basis with all our clients, because they are coming to the party. And it's one of those things that, again, you just got to really communicate with them. If you leave it and you don't lodge your BASs and you choose not to pay them, or your income tax, whatever kind of ATO debt it is, they're not going to be, or they're going to be more reluctant in terms of putting those really good payment terms in place to help you. So we're just saying early engagement with the ATO is critical here. Get your advisor or tax agent to have those discussions, work through with them, set up a plan. You might need to demonstrate that you are having some cash flow problems, that's some of the things that they're kind of asking. You know, demonstrate that you've been affected by COVID. What does that look like in terms of revenue drop and those types of things? But they're definitely being accommodating, and you know, they don't want to see businesses go under. They want to be supportive during this time. It's been a clear mandate of theirs to make sure, you know, that they are supportive, and they're definitely being helpful in regards to those conversations. And
so as a small medium business owner, is it, you know, are people doing this themselves, or are they working with is their accountant kind of normally doing that for them? How does that work?
Well, we typically work with them, but as a small business, as a small business, you can call up the ATO yourself and have those conversations. It's just where you would negotiate or work with your tax agent or advisor, because they're dealing with the ATO on a daily basis. They kind of know what the ATO is looking for, and they also know how to have those discussions to make those terms as favourable as possible. Whereas the individual calling up might just be going, oh, I think I can, you know, go for this. But in reality, you can actually get much more favourable terms. You might be able to negotiate, you know, waiving interest and all these sort of things that your tax agent does on a regular basis. So in the first instance, we'd suggest contacting your accountant and seeing what they think is the best approach.
Okay. No, good. Look, conscious of time, we've only got a minute left. You know, so we've had a couple of questions, but look, if you have more questions and you've got issues you need help with, so on and so forth, if it's kind of a legal type issue, please contact me. If it's an accounting type issue, Hugh and Jace will circulate at the end of this, we'll circulate a bit of material, so you've got our details. I think the key thing really is, you know, to sum it all up, ultimately, you know, we're in a kind of new normal now. That the economy's, you know, going to be in the state that it's in for a period of time, and we all need to kind of be aware of that, conscious of that. And if you haven't solved your kind of cash flow issues yet, there's still time to do it. And probably, again, talking about the ATO, now is the time to be having those conversations, not in a year's time when maybe things are kind of, you know, more back to normal. So, you know, there's a lot that can be done, you know, from a cash flow perspective, from a cost perspective, in terms of setting your business up for this new normal. And really, it's about acting quickly. And if you do that, and you've got a kind of solid fundamental kind of business, then you're going to be in a good position. So, look, I want to thank Jace and Hugh for taking the time to join us on this. Really super helpful. And again, just want to reiterate, we'll send around some material after this. If you need help, please reach out. We'd love to just, you know, have a chat and just run people through their various options on things. So, you know, thanks Hugh, and thanks Jace, and thanks everyone for attending. Hopefully you found it useful.
Thanks for having us, Lachlan.
Thanks, Lockie. Thanks, everyone. Take care.